Hello everyone, my name is Michael Lamott. I am the founder of ChartYourTrade.com. Our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And one of the ways that we are going to help you do that is by teaching you how to gauge the overall health of the market. It's something that's very important because every 3 out of 4 stocks will follow the path of the market, the major indexes. I'm talking about the S&P 500, the NASDAQ, the Russell, the Dow, all of those. Most stocks will follow the path of the market. And so we need to be able to determine when there will be a key turning point in the market, when the market is going to continue to rise or when it's going to ultimately roll over and correct or have more of a bear market. And so there's a number of different ways that we can determine this, and the one that I want to talk to you today is about distribution days. Now, what is a distribution day? A distribution day is a day when there is a lot of institutional selling in the market. And what's an institution? An institution are the big boys. They're the big hedge funds, the big mutual funds, the big pension funds, the ones that are pushing around billions of dollars and can move the market. They cannot all exit on the same day, otherwise the market would just crash. Or the market would just go to the moon if they're all buying at everything all at the same time. So we are able to see their buying and their selling on a chart in stages. So when volume is up on a day, above average, and the price is moving up or down, that's the major institutions that are coming in and are buying or selling on that day for any number of reasons. We could watch what they talk about on the news or in social media or wherever, but the only story that really matters is the one that's being told to us right there on the chart. It's not, we don't want to listen to what somebody else is saying, we want to watch what they're doing, and the way that we watch what someone is doing is right there on the chart. So back to distribution days. So the definition of a distribution day is any down day that is down minus 0.2% or greater than the prior day on heavier volume than the prior day. So there's a lot of nuances with distribution days, and we'll get into each of them, but a few of the nuances of these distribution days are where price is going to close in the range of the day, where if we get a cluster of these distribution days all at the same time. So if we have a distribution day yesterday and one today and another one tomorrow and another one the day after, and these distribution days start piling up in a hurry, that is something that's meaningful. And we also want to look at these distribution days when they're occurring around different moving averages. So let's take a look at some charts and see these distribution days in action and how they apply. Okay, so what we're looking at here is a chart of the S&P 500, and each of these little arrows are flagging distribution days. We're looking at this on TradingView. I don't work for them, they're not paying me anything, but I really enjoy their trading service. One, because they have a very good free service, but they also have a fantastic upgrade that's only $10 a month, and you are able to create your own algorithms or follow other people's algorithms that do different things. The one that I created was something that would flag these distribution days automatically for me, and one that would keep track of the number of distribution days over a 25-day period, so that way I know what the distribution day count is. Now, about the distribution day count and why 25 days. So 25 trading days is basically looking at a little bit over a month, right? So it's looking at 5 weeks. So anything that's longer than that, and the distribution days start to become less relevant to the current trend of the market. If you get a large number of distribution days within a 25-day period, then that's something that we really want to take notice of and put that into the many different factors that we will consider for market health. But for the sake of this video, we're just worried about the distribution days. So the distribution days are flagged here, and we could see that when they started to pile up and cluster back in mid-August, so there were 2 days back-to-back here, and then 3 trading days went by, then another 2 distribution days there, and then here's another one. Well, when they start to cluster up really over any 10-day period, we want to take notice, because that is a sign that the institutions are starting to scale out of their positions, and well, we might see a little bit of a correction. Doesn't necessarily mean that we will get a bear market or that we'll get a big correction. We obviously haven't seen a big correction in the market for quite some time right now. But when we see these little distribution days start to pile up, it's a sign that we are going to see a little bit of choppiness in the market. And that's exactly what we saw back in August. And now, by paying attention to something like distribution days, we're able to not necessarily predict, but we're able to be prepared for this kind of a choppy action in the market. Compare the distribution days and the distribution day count back then to what we're seeing presently. Now we're in mid-October, and we haven't had much distribution at all, and we've just continued to rally. You know, so that's really one way that distribution days can work to help us. Now, this algorithm doesn't it doesn't reset the distribution day count for when you have other things like a follow-through day. So if you're a practitioner of a methodology called CanSlim, you could read all about that in William O'Neill's book, How to Make Money in Stocks. But if you're a practitioner of that, this algorithm that I made, it doesn't reset the distribution day count based on follow-through days or based on moving 6% above a follow-through day. But it does count all of the distribution that we've had over a 25-day period. So just knowing that in itself is going to be useful. And for anybody that's watching this that has followed me for any period of time, you know that in order for us to be successful in the stock market with a full-time job, a family, well, with household obligations, well, with children, we need to be able to do things as efficiently as possible. And just having the distribution days flagged for us automatically and being able to track the number of distribution days over a 25-day period, those things are helpful to be able to give us a flavor of the overall market health. And it's really not an exact science by any means. It's meant to give us a flavor of the overall market health and to be able to anticipate things and to be able to prepare for them. So that way, when we do see some choppiness and a little bit of a pullback like this that we saw back in August, we're ready for it, and we can adjust our portfolios accordingly, and we could do it accordingly whether we are trading shorter term, intermediate, or long term. And that's really how distribution days and why distribution days are important. I know that distribution days is a little bit of a complicated topic. If you have any questions about it at all, please leave them in the comment section below and I will personally respond to any and all of your questions. Thank you so much for watching. I truly, truly appreciate it. Again, if you have any questions, comments, if you liked the video, let me know what you liked about it, what you got out of it. Leave it in the comments below. Your comments and questions will help other people that are watching this as well, so you'll be helping out your neighbors as well. Thanks again. Like the video, subscribe to the channel so that way you get all of our updates, and I will see you again very, very soon.